What stock do you forecast making you most of your money ROI over the next year? Oh, I have no idea. I have a lot of stocks that I plan on making money off of. I'm holding Root. Ugh. They have no debt, 600 million in the bank. They should. They're an insurance company. For your burn rate on the cash, should survive any downturn and would be well capitalized. Tech like this need to see in the overall market. I mean, advantage, right, over time. I don't like that they just did a reverse split. It's going to dry up institutional interest and make it harder for them to get financing moving forward. But they're an insurance company, right? And so they can leverage their float, not their stock float, their monetary float. Anyway, so contracting margins and larger competitors can open up market space for them to compete in if they can remain unindebted and efficient. You're looking at a long hold though. Insurance companies don't grow super fast. And they can have major setbacks. But if you're willing to give it 5 to 10 years, probably pretty good. If they can, stay on top of their tech advantage. GME March OPEX I made more money off of than BBBY, but BBBY is number 2, Cat number 3, and actually I might have made more off Cat now. Not realized, but I think I've made more off Cat now than BBBY. Remember, Cat's runs are each of them bigger than BBBY's entire run. So, SPX number 4. March OPEX definitely more than anything. I think more than anything else. At least all at once. I didn't do bad on May OPEX. Well, I didn't do terribly on it. I did really good on August ETF FTDs. Those were solid. Those were like 190, 200%. I don't know. I'd have to add up GME, but GME has been good this year. Cat is a beast. Private talks to buy Albertsons all cash. That's probably good for Albertsons shareholders, but I'm sure the price action's already been realized if the rumors are out. Cat is an incredibly forgiving stock for newer options traders, as long as they're willing to buy Theta, yeah. Cat is an unbelievable play. I've been telling everybody about it since last year. Anyway, what to say about today? So CPI numbers, like I said, not great, but better, right? And anything, the market is just waiting on anything even slightly better to turn around. We saw a lot of short side capitulation today. Not much of a sell off into close, still holding that like 369, 360 level, which is good. It's above the 3650, still below 3700, but give it time. SLD is next Wednesday. Generally, and historically, this is fairly accurate. The Monday, Tuesday, and Wednesday preceding SLD are fairly positive, unless we're already in a downtrend, a local downtrend, not long term. If we do get that, I'd expect, a 200 to 300 basis point pullback for SLD at some point during next week. And then following that, you have the big options expiration on the 21st, which is going to lead to the rest of the in the money puts capitulating. And that will start to give us some upside. Also, all that fresh margin in the institutions means they can leverage the upside as we move into earnings season for Q3. So I'm thinking good things to the market over the next few months. Obviously, today's bounce not a confirmation of no more downside yet, but it's looking better. We really want to see over 3,800 to say, okay, we're in a bear rally. It can be sustained. There's sufficient buy side pressure to keep us moving up for whatever period of time. Remember, there are currently several factors that could catalyze a market crash still, between Japan and China's treasuries, issues with the Ukraine war in Europe, and problems with Bank of England, along with the fact that the dollar is still skyrocketing and will only go up further with increased interest rates. Don't expect this rally to be as strong as the last one or to reach the same highs, but it could still go up. Like, we have probably a potential range of like 41.35. But that's really on the bullish side, right? Like, that means we get positive Q3 earnings out of some big mega caps. The market gets some fuel to run on. If we don't see that, if we see a continued drawdown in earnings and reduced margins, that'll only get worse until Q4 reports. And then when forward guidance comes out for the next year, it's going to be abysmal. And then you're going to see equity sell-offs from large institutions, right? And that's what's preventing a crash right now, is they're not, remember that when we're looking at all of this, right? And I try to remind people about this as often as possible because I think people forget all the time. Um, we just had a market crash, right? It wasn't that long ago. And institutional positioning, is still very much in this range. So, even here, and this is scary for them, they're still up, right? And they're buying this is their core positioning. They're buying this positioning for leverage and margin, right? They don't want to sell it. It's not ideal. And, also every week you have millions of dollars across the country from 401ks and, pension plans flooding into the market. So the market always has positive pressure. And you really need an equity sell-off to create a crash. You need fear and panic. And when that happens over time, because the flow of information is faster and faster, crashes and their recovery periods become shorter and shorter. But we still need that, and we don't have anything to catalyze that right now. They're not going to sell out of their significantly in the money core positions without a catalyst. Now, if there is a catalyst, there's like a contagion and it's widespread, and that could force equity sell-offs. But if those equities are no longer showing growth potential, they will sell them, right? And that's when we start to look out into like Q1 and Q4 and Q1 earnings for next year, because mega caps have been struggling with the supply shock, and now they're going to be struggling with the constantly increased rates, and all of these companies have massive amounts of corporate debt, right? There's no way they can continue to operate at the profit to earnings ratios they're currently trading at through next year. So they will have to inform investors of that. And when they do, when that potential for growth is removed, then institutions are going to pull their money back. They're going to sell, right? Because there's no more opportunity in owning it. And that's when we could get enough equity sell-off to catalyze a crash. And I think even if we do, it'll be brief. And I think in turn, around that same time, the Fed is going to attempt to pull back rates. They're going to start pulling back rates, and they're going to reduce on RRP, like interest, right? And so when they do that, that forces the banks to take all that liquidity that they haven't been deploying in the equity markets, and they're going to have to go out into the markets and buy shit. And when the Fed forces that, that's going to push the market back up. And that's kind of what we were talking about with like how they plan to facilitate their soft landing. And I've gotten off on a whole tangent here at this point. So, yeah, fun stuff. Anyway, thank you guys so much for tuning in, and I'll see you bright and early tomorrow morning. Have a good night, everyone.